Please note that this analysis is purely educational and does not constitute investment advice. Imagine a financial engine that has reliably printed cash for over a decade. Now imagine its operators suddenly and deliberately locking the vault. This chart tracking GAAP net income shows the raw scale of Alphabet's first quarter in 2026. The company reached a towering $110 billion in top-line revenue, driving that final bar past $60 billion in net income, an 81% year-over-year expansion. The business generated more pure profit than at any point in its history. Yet Alphabet reduced its share buybacks from $15.1 billion in the first quarter of 2025 to exactly zero. Going further, internal financial models project Alphabet's free cash flow will drop to negative $16 billion for the full 2026 fiscal year. A historical cash printing machine is intentionally sacrificing its near-term free cash flow and eliminating equity yield. The management team has actively chosen to divert every available dollar away from shareholders and into raw infrastructure. Alphabet is reallocating its capital to finance the most aggressive infrastructure cycle in the company's history. This strategic urgency originates directly from top leadership. The internal directive is clear: prioritize AI compute capacity at all costs. To understand exactly where tens of billions of dollars in free cash flow are disappearing, we have to deconstruct the pipeline connecting physical capital expenditures directly to Google Cloud Platform revenue. The institutional anxiety on Wall Street centers on a single question: is Alphabet blindly overspending into an AI hardware bubble, or are they rationally chasing contracted, guaranteed demand? Physical compute capacity now dictates the ceiling for scaling digital products. Growth is limited by the immediate availability of processors. Analyzing Alphabet's exact Q1 metrics reveals that a projected negative free cash flow is actually an indicator of overwhelming, unfulfilled market demand. To underwrite a multi-year $190 billion expenditure cycle without leveraging massive external debt, the underlying core business must be operating at absolute peak efficiency. This chart detailing Google Services revenue proves the core engine is delivering. The steady staircase growth culminates in a Q1 2026 peak approaching $90 billion. That reflects a 19% expansion in search and other revenue, alongside a matching 19% growth in subscriptions. That top-line growth is impressive, but building large language models is expensive. Alphabet increased its research and development costs by 26% year-over-year to support these new AI products. On this margins chart, despite the heavy R&D hike, the brown line tracking Google Services operating margin expanded to 45.3%. And looking at the dark blue line, the consolidated operating margin expanded to 36.1%. Operating efficiency held steady across the portfolio. Higher engagement with Search's AI overviews and strong direct response on YouTube are actively driving better monetization profiles. Combine that with strong ad spend in the retail and financial sectors, plus a favorable foreign exchange tailwind, and the profit margins absorbed the heavier R&D load with room to spare. The core services division is successfully acting as the ultimate funding engine. Alphabet can aggressively invest in AI while protecting the unit economics of its core ad products. The cash generated by the ad business is immediately deployed into physical infrastructure. This chart shows the exact scale of that deployment. The final bar marks a Q1 capex of $35.7 billion, a 107% year-over-year increase. Tracing the purple dashed line for capex as a percentage of revenue, the aggressive ramp in capital intensity is unmistakable. Inside that $35.7 billion, approximately 60% was dedicated exclusively to physical servers, with the remaining 40% spent on the data centers and networking equipment needed to connect them. Based on this burn rate, management raised their full-year 2026 capital expenditure guidance from a midpoint of $180 billion up to a range of $180 to $190 billion. The guidance raise explicitly absorbs the Intersect acquisition, a strategic move to consolidate market position during the infrastructure ramp. The cash flow math leaves zero ambiguity. The company generated $45.8 billion in operating cash flow, but after subtracting the capex ramp, actual free cash flow dropped 47% to just $10.1 billion for the quarter. This hardware cycle is so capital-intensive that internal models flag annual free cash flow dipping negative by $16 billion. The decision to eliminate buybacks is pure arithmetic. Management determined that converting incremental cash into silicon yields a significantly higher long-term return than repurchasing their own stock. What exactly justifies a $190 billion capital expenditure cycle? Unfulfilled, contracted enterprise demand. Sundar Pichai stated outright, "Cloud revenue would have been higher if we were able to meet the demand. The company is physically compute constrained. We can measure that unfulfilled demand through RPO, or remaining performance obligations. This cloud backlog serves as the ultimate leading indicator of future revenue. In the first quarter of 2025, that backlog sat at $93.2 billion. By the first quarter of 2026, it scaled violently to $462 billion, a massive 395% increase. That backlog is driven by a 2x year-over-year increase in new customer acquisition, bolstered by multiple infrastructure deals exceeding $1 billion each. Within that cloud segment, generative AI product revenue specifically is up 800% year-over-year. This quarterly revenue chart illustrates how that backlog translates to current execution. The final bar shows Google Cloud crossing the $20 billion revenue threshold, pushing the orange year-over-year growth line to 63%. This operating margin chart knots out GCP's profitability as it scales. The final data point confirms a 32.9% operating margin, a 1,510 basis point improvement over a single year. The capital expenditure to GCP thesis is validated. Alphabet is not guessing at future adoption. They are building physical capacity as fast as possible to fulfill $500 billion of contracted, high-margin enterprise commitments. The prevailing institutional fear is that massive AI spending is a bridge to nowhere. The data tells the exact opposite story. Alphabet's first quarter reality is a clean logic flow. A $190 billion capital expenditure fuels a $462 billion enterprise backlog, yielding a 32.9% operating margin. Combined, these metrics map a de-risked path to a massive internal rate of return on every incremental dollar spent. Furthermore, management expects over 50% of that massive backlog to be recognized as realized revenue within the next 24 months. A $500 billion backlog provides the context for the buyback suspension. Management is prioritizing the higher internal rates of return found in silicon over the yield realized by retiring equity. Deploying every available dollar into physical infrastructure before compute ceilings limit your top-line growth is the optimal mathematical move. A projected $16 billion free cash flow deficit for 2026 is a signal of high internal confidence. Management has already indicated that capital expenditures will increase again in 2027. The investment cycle has not peaked because the demand curve has not flattened. The hyper-efficiency of the core search business provides the cash required to play this aggressive long game. Alphabet is transitioning from a legacy advertising cash cow into an AI infrastructure monopoly. Alphabet is demonstrating that capital discipline means prioritizing high-margin infrastructure builds over near-term cash flow metrics.